Most people, without knowing it, use a system of accounting known as single entry accounting, where they record transactions relating to their checking or saving account. For each transaction, one entry is made, either an increase or decrease in the balance or cash in the account. Likely, the single most important aspect of GAAP is the use of double entry accounting, a company system of debits and credit. With double entry accounting, each transaction results in two entries being made. These two entries collectively make up what is known as a journal entry. This is actually fairly intuitive when you think back to the accounting equation: assets equal liability plus owner's equity. If each transaction results in only one entry, the equation would no longer balance. That's why with each transaction, entry will be recorded to two accounts. Let me give you an example. A company used $40,000 cash to purchase a new piece of equipment. In the journal entry to record this transaction, cash will decrease by $40,000 and equipment will increase by $40,000. As a result, the asset side of the equation will have a net change of zero and nothing change at all on the liability plus owner equity side of the equation. Alternatively, if the company had purchased equipment with a loan, the journal entry would be an increase to equipment of $40,000 and an increase to note payable of $40,000. In this case, each side of the equation would have increased by 40. So what is debit and credit? Debit and credit are simple the term used for the two halves of each transaction. That is, each of these two entry transactions involves a debit and a credit. Now, if you've been using a bank account for any period of time, you likely have an idea that debit means decrease while credit means increase. That is, however, not exactly true. A debit or credit to an account may increase it or decrease it depending on what type of account it is. A debit entry will increase in an asset account and it will decrease a liability or owner's equity account. A credit entry will decrease an asset account and it will increase a liability or owner's equity account. For the perspective of your bank, your checking account, it's a liability. That is, it's money that they owe to you. And because it's a liability, your bank credit the account to increase balance and debit the amount to decrease the balance. Now, let's apply the system to our earlier example. A company used $40,000 cash to purchase a new piece of equipment. Cash will decrease by $40,000 and equipment will increase by $40,000. To record this decrease to cash and asset account, we need to credit cash for $40,000. To record this increase to equipment and asset account, we need to debit equipment for $40,000. This transaction could be recorded as a journal entry like this. As you can see, when recording a journal entry, the account that is debited is listed first, and the account that's credited is listed second, with the indentation to the right. Also, debit is conventionally abbreviated as DR, and credit is abbreviated as CR. An easy way to keep everything straight is to think of debit as meaning left, and credit as meaning right. In other words, debit increase amount on the left side of the accounting equation and credit increase the account on the right side. Also, this helped you to remember that the debit half of a journal entry is on the left, while the credit half is indented to the right. Let's take a look at a few more examples to see how it would be recorded as a journal entry. For example, Chris Construction takes out a $50,000 loan with a local bank. Cash will increase by $50,000 and note payable will increase by $50,000. To increase cash and asset account, we will debit it. To increase note payable, a liability account, we will credit it. Now, here's another example. Last month, Chris Construction purchased $10,000 worth of building supplies. Using credit to do so, building supply and account payable each need to be increased by $10,000. To do so, we debit building supply and credit account payable. Eventually, Chris Construction will pay the vendor for the supplies. When they do, we'll need to decrease account payable and cash by $10,000 each. To decrease a liability, we debit it, and to decrease an asset, we credit it. So far, we only discussed journal entries that deal exclusively with balance sheet accounts. Naturally, journal entry need to be made for income statement transaction as well. For the most part, when making a journal entry to a revenue account, we use a credit, and when making an entry to an expense account, we use a debit. This makes sense when we consider that revenue increase owner's equity and that expense decrease owner's equity. Let's take a look at an example. Darrell Stress writes a check for their monthly rent, which is $4,500. We need to decrease cash and increase rent expense. And here's another example. Connie, a software consultant, make a sale of $10,000 and is paid in cash. We need to increase both cash and sales by $10,000 each. And sometimes a transaction will require 2 journal entries. For example, Darrell's dresses sells a wedding dress for $1,000 each. Darrell had originally purchased a dress from a supplier for $450. We have to increase sale and cash by $1,000 each. We also have to decrease inventory by $450 and increase cost of goods sold and expense account by $450. The general ledger is a place where all of a company's journal entries gets recorded. Of course, hardly anybody uses an actual paper document for a general ledger anymore. Instead, journal entry are entered into a company's accounting software, whether it's a high-end customized program, a more affordable program like QuickBooks, or even something as simple as series of Excel spreadsheet. The general ledger is a company's most important financial document. It is from the general ledger's information that a company's financial statements are created. In many situations, it can be useful to look at all the activities that have occurred in a single account over a given period of time. The tool most frequently used to provide this one account view of activity is known as the T account. One look at an example of a T account and you'll know where it gets its name. This T account shows us that over the period in question, cash has been debited for $400, $550, and $300, as well as credited for $200 and $950. Often, a T account will include the account beginning and ending balance. This T account shows us that at the beginning of the period, inventory had a debit balance of $600. It was then debited for a total of $750 and credited for a total of $500. As a result, had a debit balance of $850 at the end of the period. A trial balance is simply a list indicating the balance of every single general ledger account at a given point in time. The trial balance is typically prepared at the end of a period prior to preparing the primary financial statement. The purpose of the trial balance is to check that debit in total are equal to the total amount of credit. If debits do not equal credit, you know that there's an erroneous journal entry must have been posted. While a trial balance is a helpful check, it's far from perfect, as there are numerous type of error that a trial balance doesn't catch. For example, a trial balance wouldn't alert you if the wrong asset account had been debited for a given transaction, as the error wouldn't throw off the total amount of debits. So now here's the summary. For every transaction, a journal entry must be recorded that includes both a debit and a credit. Debit increase asset account and decrease equity and liability account. Credit decrease asset account and increase equity and liability account. Debit increase expense account while credit increase revenue account. The general ledger is a document in which companies' journal entry are recorded. A T account shows the activity in a particular account over a given period. And a trial balance shows the balance in each account at a given point in time. The purpose of a trial balance is to check the total debit equals total credits.